Welcome, curious minds, to another deep dive. Today, we're zeroing in on a real giant of global industry, Caterpillar Inc. You know them, ticker symbol CIT. When you think heavy machinery, right? That iconic yellow equipment, that's them. Powering construction, mining, energy, pretty much everywhere. So we've pulled together a bunch of sources for you: stock reports, earnings calls, analyst takes, the latest news, our mission to give you a quick way, a shortcut really, to grasp Kenny's financial health, their competitive edge, and what might be next. Think of it as your fast track to getting smart on a company that's, well, foundational. And speaking of right now, the stock's around $427.72 USD. It took a bit of a dip recently from about $434.23. What's going on there? What do you really need to know about these moves?
Yeah, that's exactly it. We're here to pull together the numbers, the data, and also the sort of qualitative stuff from these sources. The goal is to help you understand not just what the recent numbers were for Caterpillar, but really why they matter, especially for a company this big in today's market.
Okay, let's do it. Let's unpack that recent Q2 2025 earnings report. The headline seemed, well, a bit mixed. Sales kind of okay, but profit dipped. What are the key numbers we need to focus on there, and why the profit dropped?
Right, so Q2 2025 reported August 5th. Sales and revenues hit $16.6 billion. That was down just 1% year over year, pretty much what analysts expected. But adjusted profit per share, that came in at $4.72, and that missed the consensus estimates, significantly down from $5.99 the year before. Now, the main reasons, two big ones. First, unfavorable price realization. Basically, they couldn't quite get the prices they wanted, maybe competition, maybe incentives. But the bigger hit, that was the rising cost of incremental tariffs. Still, it's interesting. The adjusted operating profit margin was 17.6%. That actually beat expectations, even though it was lower than last year's 22.4%.
Huh. Okay. So tariffs, definitely a drag on the bottom line. But wait, profits down, but profit margin better than expected. How does that work? Seems a bit counterintuitive.
That's a really good point. It's a bit nuanced. So while the total profit, the dollars per share, was lower because of those tariffs and pricing impacts, Caterpillar did a pretty good job managing their internal costs, operational stuff, production efficiencies within the quarter. That cost control, plus the sales they did make, meant they kept a healthier margin on each dollar of revenue than people thought they would, even with revenue slightly down. It kind of shows their internal discipline, despite the outside pressures.
Gotcha. Okay, so running a tight ship internally, even with those headwinds. Given that, were there any real bright spots if we dig into the segments? CAT's so diverse, there's usually something growing.
Oh, absolutely. There was one major bright spot, and it really points to where CCAT might be heading. That's the Energy and Transportation Division. Sales there jumped a solid 7%. And that was mostly driven by a huge 28% surge in power generation sales, the driver. It's what you hear everywhere now. Massive energy demand from data centers, cloud computing, all that generative AI stuff needing power. This isn't small potatoes. It really signals Caterpillar making this quiet, but pretty significant pivot towards energy infrastructure for the digital age. And that stands out because, in contrast, construction industries were down 7%, resource industries down 4%. Tariffs and pricing were big factors there, yeah.
Yeah.
Sometimes they use, attractive deals to move machines, which helps volume but hurts margins.
Yeah.
But it's also just, well, some slowdowns in global construction, commodity price swings hitting those more traditional areas too.
That energy pivot. Wow, that's really interesting. Okay, moving past the quarter itself, our sources keep talking about CCAT's wide economic moat. It's like their superpower. For anyone listening who isn't familiar, what exactly gives Caterpillar this incredible competitive edge?
Yeah, that moat is really built on several strong pillars. It makes it incredibly tough for anyone else to really challenge them. First, just their sheer global footprint. Unmatched reach, huge diversity in what they sell and where, servicing so many different end markets globally. Trying to replicate that. Almost impossible for one competitor. Second, they have this unique global supply chain setup that lets them be cost competitive worldwide, but still keep a big presence in the U.S. That's not just about saving money. It's strategic. It gives them resilience. Then you've got these deep, long-term customer relationships. I mean, they're planning years ahead with huge clients like those data centers we talked about. And that leads directly to really high switching costs.
Right, once you're set up with CAT.
Exactly. You're invested. Not just in the yellow iron itself, but the operator training, and crucially, that massive global dealer and service network. Life cycle support. It's a whole ecosystem, not just a machine. And Cat Financial helps too. Their financing rates are attractive, makes it easier to buy that expensive gear. It keeps customers sticky. It's a sales tool, really. Plus, you can't ignore the backlog. A record $37.5 billion.
$37.5 billion.
Billion, yeah. Think about it, that's like 2 full quarters of their current sales already locked in. Gives them a great cushion, amazing revenue visibility.
That backlog alone says a lot. And you mentioned innovation, too.
Oh, definitely. Innovation is key. They're constantly investing, developing things like autonomous tech for mining and construction. Super cutting edge. And critically, boosting their large engine capacity. Why? For those booming sectors like data centers, generative AI, that need for power. These are just side projects. They're central to staying relevant long term. I mean, data center power use is exploding, becoming a grid issue. CTAT wants to be the solution provider there.
It really sounds like they are playing the long game, building for what's coming, especially with that energy focus. So, looking beyond just Q2, what are the big long-term opportunities the sources see for Caterpillar? Where could they be headed?
Well, looking further out, there are some powerful forces working in their favor. The whole changing energy landscape that's expected to keep driving demand for commodities, which helps the resource industry side. And that huge, almost unending demand for power generation data centers, AI, that's a massive, sticky opportunity we keep coming back to. These big data center projects take years, need reliable power. ID's position there, their relationships, their tech, it's invaluable. They also stand to gain a lot from global infrastructure spending, the IIJA Act here in the U.S., other programs globally. And they're investing to meet that demand, like boosting large engine capacity at their Lafayette facility. They're talking about a step change in capacity coming late 2026, maybe early 2027. So they're clearly gearing up, preparing for significant future demand based on these big trends.
Okay, so we have these major strengths, this compelling long-term story. But you mentioned the sources also flag some big challenges and, importantly, worries about the stock's valuation. What does all this mean for someone looking at ZIT stock today? What are those immediate hurdles?
Right. You absolutely have to balance the long-term view with the near-term picture.
Yeah.
And there are real challenges. Tariffs are still the biggest headache. For the full year 2025, they're expecting a net cost impact of $1.3 billion to $1.5 billion. That's a huge number. It's going to push their operating profit margins likely into the bottom half of their target range. It forces tough decisions, manufacturing pricing. Then there's that unfavorable price realization issue, especially in construction. Those merchandising programs, they move machines, keep factories busy, which is good, but they often involve discounts, right? So it squeezes the profit on each unit sold. We've also got higher restructuring costs this year, about $300 to $350 million, some of that from selling off parts of the business as they streamline, and even in energy and transportation, where growth was strong. There are some, let's call them, operational inefficiencies right now. And they're making huge investments in capacity while trying to ramp up output. It's like trying to rebuild the plane's engine while it's flying full throttle. Necessary, but tricky. And lastly, the outlook for services revenue is kind of flat. Fewer big machine rebuilds happening, tied partly to lower coal prices and more trucks being parked in some resource sectors.
Okay, so those are real immediate pressures. And then the valuation, the sources seemed pretty clear on that concern. Where does Sayakati stand there?
Yeah, this is crucial for any potential investor. The price. The stock's trading at $434.01. And the sources we looked at put their fair value estimate much lower, like $346.62, and their price target around $382.06. That gap suggests the market might already be baking in a lot of that long-term growth, those future opportunities, while maybe, just maybe, underestimating some of these headwinds we just talked about. Just for context, the average analyst price target over the last 6 months is also way lower, around $333.75. So you see this big difference between where the stock is and where analysts think it should be. It implies that while Sayaki has a great long story, the current price might already reflect a very sunny outlook. The question for you, the listener, is that market optimism justified right now? Or are the near-term challenges likely to slow things down more than the price suggests?
That's a really critical point for anyone considering the stock. So it's this fascinating mix, isn't it? You've got undeniable long-term strengths, that strategic energy pivot, a powerful moat, but set against very real near-term pressures, tariffs, operational tweaks, and a valuation that looks, well, stretched to some. What's the big takeaway for you from this deep dive into Caterpillar? We've seen this company, strong moat, exciting future, tied to infrastructure and digital growth.
Yeah, but that immediate path forward, it's definitely got shadows. Those tariff impacts are significant. The operational adjustments are ongoing. And the stock valuation suggests maybe a lot of good news is already priced in.
It's a classic situation.
I mean, strong fundamentals bumping up against current market realities and those immediate hurdles. Understanding that tension, that balance is really key here.
And it raises a really interesting question for all of us, doesn't it? In a world needing both old school physical infrastructure and hungry new digital infrastructure like data centers, AI, how does a company like Caterpillar, sitting right in the middle of both, balance those immediate financial challenges with that long-term vision, and crucially, justify its current market price. Definitely something for you to mull over as you think about the future of global industry and where giants like CA fit into it all. All right, that's our deep dive on Caterpillar for today. If you found this useful, if you want more analysis like this, please do subscribe to the channel and definitely hit that bell icon. That way you get notified about all our future deep dives. Your support genuinely helps us bring you more of this in-depth knowledge faster, cutting through the noise for you. Thanks for joining us.